Hello everyone. In this video, I will discuss an example of Proposition 1. In the last video, we have seen that argues that capital structure decision doesn't have an impact on share price. Argues that as the company changes its capital structure, it is not supposed to have an impact on share price because shareholders themselves decide their investments proportion coming from their own fund or coming from the borrowed fund. So what investors can do by themselves by changing these decisions or by creating these decisions, company cannot have an impact on their share price. So look at this example. Macbeth Sport Removers is reviewing their capital structure. It is currently all equity financed. Its number of share is 1,000. Share price is $10 and market value of share is 10,000. And operating income are the different operating income where if it is 1,000, then earning per share is 1 and return on share is 10. And this operating income is 1,500, which is the most expected one. If operating income is 2,000, earning per share will be respectively 1.5 or 2, and return on share is 15% and or 20% respectively. Now, Macbeth, the firm's president, has come to the conclusion that shareholders should be better off if the company had equal opportunities of debt and equity. She therefore proposes to issue 5,000 of debt at an interest rate of 10% and use the proceeds to repurchase 500 shares. Right? So what happens is you can remember that previously the number of share was 5,000 now, and there was no debt. Now company issues 5,000 debt and used to repurchase shares, 5,000 shares. As a result, now market value of share is 5,000 and number of share is 500. Price per share is still $10. And under this different operating income, you can see that earning per share and return on share changes. Previously, earning per share under the different operating income was 0.5, 1, 1.5, and 2. Now you can see it's 0, 1, 2, and 3 because of the changes in this. So now the company has to pay an interest of 500. So you can see that when operating income is 1,500, earning per share is 2 and 3 respectively, and return on share is 20 and 30. So where 1,500 and 2,000, previously it was 1.5 and 2, and return on shares was 15 and 20. So you can see that for this leverage, the earning per share and return on share increases when operating income is greater than 1,000, right? However, previously when operating income was 500, the earning per share was 0.5 and return on share was 5%. Now when operating income is 5,000, earning per share is 0, return on share is 0%. So what we find is if operating income is greater than 1,000, then company is better off using leverage, using debt, because its earning per share and return on share is higher. However, if company's operating income is less than 1,000, the company is worse off for using leverage, as its earning per share declines to 0 and return on share declines to 0%. So whether a company uses debt or company gets an advantage of debt depends on the expected operating income of the company. Okay. Now let's consider another alternative. Previously, we have seen two examples. Initially, the company was all equity, and then the company decided that they will go for 50% debt and 50% equity. Now, let's take another example where Macbeth is still equity finance and debt is replaced by investors. What happens is now an investor decide that investor will invest in the Macbeth shares. So in fact, investor will use its own fund to buy one Macbeth share and will borrow money to buy another Macbeth share. So effectively, the investor will invest in 2 shares where investment for each share will come from his own pocket, and for the another share it will come from borrowing. So here is the case of the earning per shares. So since the investor borrows, so interest has to be paid, and net earnings on investment and return on investment is this, which is essentially the same return on investment the previously was. So you can see that in this example, the investor is using his own fund and borrowed money to invest, whereas previously the company itself was deciding that 50% of the capital will be debt and 50% capital will be the equity. So since if company is all equity finance, the investor can change investor's position and can make the investment 50% debt and 50% equity, and having the same impact if the company was 50% debt and 50% equity. That's the reason by changing the capital structure, company cannot have impact on share price, because this is something the shareholders can do by themselves. And this is what exactly argued in proposition 1. Now, in this diagram, you can see that how leverage affect earning per share. Okay, this brown line shows the earning per share that would vary for operating income under when the company is all equity. So it therefore simply a plot of the data we previously have seen here. Okay. On the other hand, the green line, it shows the earning per share that would vary given equal proportion of debt and equity, so which is essentially the plot of the data we have seen in this table. Okay, so you can see that here the two line intersects where the earning per share will be the same as you go for all equity or go for the debt and equity. Now you can see that at this level the earning per share is same. However, if our operating income is greater than this, in this case you can see that greater earning per share will be generated when you go for the debt and equity. However, I mean the combination of debt and equity. However, if your operating income is less than this, then you will be better off if you go for all equity financing. Okay, so proposition 1 essentially argues that if capital markets are efficient, capital markets are well functioning, then firms cannot increase value by tinkering with capital structure, because the capital structure decision can have the same impact if the shareholders change their own investment by investing their own fund or by borrowing. Now, from this table, you see that leverage increases the expected stream of earning per share. You can see the earning per share. This is for proposed debt and equity, and this is for all equity. So earning per share is higher for debt and equity. However, if you look at price per share remains the same. The reason is that the change in the expected earning stream is exactly offset by a change in the rate at which earnings are discounted. The expected return on share, which is a perpetuity, is equal to earning price ratio, increases from 15% to 20%. So in the later case, since expected earning per share increases, although you have a greater earning, you are discounted it by a higher rate. As a result, the price per share remains the same. And in this case, since your expected return is lower, even if your earning is lower, since this earning is discounted at a lower rate, the price per share remains the same. Okay, so expected return on asset is expected operating income divided by market value of all security, and this is the return on asset. We are familiar with this formula, which is the proportion of debt, return on debt, which is the proportion of equity, and return on equity. So this is the end of our discussion on proposition 1. In the next video, we will discuss proposition 2. Thank you.